So in terms of material changes to the trust positioning, those kind of happened in the second half of last year when we actively moved the equity portfolio to be more value weighted and protect us a bit from what we saw as likely rising in bond yields coming into this year. This year, we haven't changed the positioning too much, but we've tried to lean into some of the factors in the market that have been out of favour. So we've been adding a little bit more growth. But the main thing we've tried to do is just diversify and build resilience in the income within the trust. So positioning as it stands today, in terms of factor exposure, is quite neutral, but with a weighting towards income, because we see income, particularly at the moment, as quite attractive, a meaningful source of return. And we just want to make sure we can deliver a really high level of resilient income to shareholders from the trust. Performance for the trust year to date has lagged the market, but hopefully that's something that shouldn't surprise, and there's good reasons why that's been the case. If we think about how the Shires portfolio is made up, we have two big blocks in that portfolio that correlate negatively to bond yields. So firstly, we have the holding in the Aberdeen Smaller Companies Income Trust. That is quite a growthy set of equity holdings, and as we see bond yields rise naturally, they will underperform by some extent, but over the long term, they're very good sources of growth and diversification for this portfolio. More meaningfully, we have about 30% of assets in preference shares, and they trade somewhere between bonds and equity. So again, as we see bond yields rise, the preference shares tend to lag the market a bit. And that has certainly been a headwind year to date. But that preference share position continues to do its job for the portfolio, which is deliver a really high, stable, reliable source of income. At the moment, the headline yield on that preference share portfolio is over 7%. So we have an outlook to that delivering really strong, positive real yields going forwards. And given the perpetual nature of those investments, it's a source of yield for years to come. So we continue to like that positioning. The equity portfolio, other than those two positions, has outperformed the benchmark year to date. Our strong positioning in energy and financials has paid good dividends, literally, and that's helped balance off some of those headwinds and kept performance in touch, at least with the market year to date. So if we start with some of the positions we've exited year to date, then United Utilities was one, a very defensive utility in the UK space, which had performed very well during the initial sell-off at the start of the year. We saw it as being closer to fair value and had limited difference to consensus, so decided to move on. We sold out of Fortum, which is a utility in Europe with a reasonable amount of Russian exposure, and we just saw too much uncertainty in there to rely on the dividend going forwards and decided to exit that position. And the third position we exited recently was Euromoney, which has been a long-term holding in the portfolio, but was bid for in the last 6 months, and therefore we exited that. That's a nice profit, so time to move on and reinvest in some other newer ideas. When we think about the things we've been buying, the overall theme has been to try and diversify and just grow income within the portfolio. So examples there would be Legal & General, a very attractive 8% dividend yield, and with a number of tailwinds coming its way. It's been slightly weak year to date because the market is concerned about credit losses within their portfolio. We see rising interest rates as a tailwind for them, and we see potential Solvency II reform in the UK market as a meaningful change for them going forward. So a good opportunity to enhance income a little bit. Then we've been trying to buy some of the higher quality names that have just derated this year. So examples of that would be Hiscox, which has a very strong position in the reinsurance market, Kone, which does lifts globally and is a nice, good structural growth market, and some other diversifiers for income. So an example of that would be Engie, which is a French utility, another really attractive 8% dividend yield, but also with a source of really good structural growth from renewables over a multi-decade timeframe. Looking back at two of those new holdings in the portfolio, I think we've found some good examples of really good quality stocks which have become cheaper year to date, and where, for those of us with a long-term investment view, there's a really attractive entry point. Hiscox is one good example of that, a really strong player in the UK reinsurance market. which has probably underperformed a bit in recent years, but where a relatively recent CEO is getting his arms around that business, delivering operational improvements into a market which is also improving. So we're seeing hardening in reinsurance pricing at the moment, which is a really meaningful tailwind for Hiscox. If we think longer term, it also has a really good quality US retail business, which is targeting a really underpenetrated bit of the insurance market around SMEs in the US. An area we think could grow meaningfully over a 10-year time horizon and a nice tailwind for growth. In terms of valuation, it's one which yields about 3.5%, so around the market level, and trades on less than a 10 times P price to earnings multiple. So an attractive valuation for what we believe to be a really quality company. The second new position I'd say a bit more about is Kone. So they are a producer and servicer of lifts globally, and another stock which has derated quite a lot year to date. So at the time we entered it, it had come down in price by about 35% year to date, and the dividend yield had gone up over to about 4.5%. That's really linked to the company's exposure to China, where there are more concerns about the Chinese property market and the pace of building in China. We see that as a short-term headwind, but this company is exposed to some pretty strong structural growth in the long term. And the important point to realise is that it makes the majority of its money from service contracts on existing installed lifts, something that carries on through cycle and will remain a very strong source of cash and therefore dividends for shareholders over the long term. So a really attractive entry point for what we see as a really quality name. So the key theme for the trust is really the importance of income right now. I think we've come through a period over recent years where bond yields have fallen consistently and therefore capital values in equity markets have gone up. And for end investors, that's been great. They've had an opportunity to sell down positions and realise income in that way. We've been in a market, certainly year to date, where the outlook has been a bit more difficult. Market levels have come down a bit. And actually realising income is harder than it has been. So we recognise the importance of generating through cycle resilient income. And we're trying to really deliver that through this trust, through the portfolio of quality equity holdings and preference shares over time. And we're really trying to enhance that at the moment. We also think it's a really good time to be exposed to UK equity income. We've seen the UK market be weak recently. Obviously, there's a bit of turmoil around politics and economics in the country. But the weak pound, for example, is a beneficiary for the UK market, and it trades at a record discount to other developed markets at the moment, with by far the highest dividend yield of any market. We also see really good exposure to some themes which will be important over the next 10 years or so. So energy, materials, utilities, all of which will be growth areas in our view. The UK market is a great way to access them, and therefore this makes a really good entry point for the trust portfolio and for the outlook for the UK in our view.